March 2020. While everyone else panic sold their portfolios, Ray Dalio quietly bought $1.5 billion in gold. Not stocks, not Bitcoin, gold. 6 months later, it hit record highs. He wasn't lucky. He was prepared. And what he bought reveals something most investors will never understand about how the ultra-wealthy survive market crashes. They don't predict them. They position for them. Here's what nobody tells you. Billionaires aren't smarter than you. They're not reading secret reports or getting insider tips from shadowy figures in marble offices. What they have is a playbook, a specific sequence of moves they make when volatility spikes, when central banks start mumbling about inflation, when headlines scream crisis, but nobody knows which crisis yet. And the wildest part, you can see exactly what they're doing. It's public record. You just have to know where to look. Let's start with the thing that sounds boring but prints money during chaos. Treasuries, specifically short-term U.S. Treasury bills. When Paul Tudor Jones smells trouble, he doesn't just sit in cash. Cash loses value to inflation. Instead, he parks hundreds of millions in 3-month and 6-month T-bills. Why? Because they're backed by the U.S. government, they're liquid, and during market crashes, they actually go up in value as everyone runs for safety. It's not sexy. It won't make you rich overnight, but it keeps you alive when everything else is burning. Then there's the move that separates tourists from pros, inverse ETFs. These are funds designed to profit when markets fall. Think of them as financial insurance that pays out during disasters. When Warren Buffett's Berkshire Hathaway starts trimming stock positions, guess what else appears in institutional filings? Positions in instruments that benefit from downturns. He's not betting against America, he's hedging, and here's the kicker. Most retail investors have no idea these even exist. They watch their portfolios bleed while billionaires collect checks on the way down. Gold shows up everywhere, every single time. It's almost boring how predictable it is. Stanley Druckenmiller, one of the greatest traders alive, loaded up on gold miners before the 2008 collapse. Not physical gold bars buried in a vault somewhere. Gold mining stocks. Why? Because when gold prices rise, mining companies don't just benefit, they explode. A 20% jump in gold can mean a 60% surge in miner stocks. It's leveraged exposure without the complexity of futures contracts or derivatives. Simple, brutal, effective. But some billionaires go darker. They buy fear itself. The VIX, often called the fear index, measures market volatility. When it's low, everything feels calm. When it spikes, panic sets in. Investors like Bill Ackman don't just watch the VIX, they buy it. In February 2020, Ackman spent $27 million on volatility contracts. 1 month later, as COVID crashed markets, those contracts were worth $2.6 billion. That's not a typo. He turned $27 million into $2.6 billion by betting that fear would spread, and it did. Now here's where it gets interesting, real estate, but not the kind you're thinking. Billionaires don't buy suburban homes before crashes. They buy distressed commercial properties, farmland, and industrial warehouses. Why? Because during recessions, prices collapse, but the underlying assets don't disappear. Jeff Green made $800 million shorting subprime mortgages in 2008, then immediately turned around and bought foreclosed properties at 30 cents on the dollar. 5 years later, those same properties tripled in value. Crashes don't destroy wealth, they transfer it, and real estate is where that transfer happens in slow motion, visible to anyone paying attention. Then there's the move almost nobody talks about. Dividend aristocrats. These are companies that have paid and increased dividends for 25 consecutive years or more. During the 2008 crash, while tech stocks imploded and banks collapsed, companies like Procter & Gamble, Johnson & Johnson, and Coca-Cola kept paying shareholders. Billionaires didn't abandon stocks entirely. They rotated into the ones that generate income regardless of market conditions. It's not about growth, it's about survival. And when you're sitting on billions, a reliable 4% yield during a crash is better than a 40% loss chasing hype. But the smartest ones do something that sounds insane. They hoard cash, not because cash is king, because optionality is king. Carl Icahn has openly admitted to holding 30% or more of his portfolio in cash during uncertain times. Why? Because when assets are cheap, you need dry powder to deploy. If you're fully invested when the crash comes, you can't buy anything, you just watch. But if you've been patient, if you've stacked cash while everyone else chased returns, you become the buyer when everyone else is the seller, and that's when generational wealth gets built. Notice the pattern yet? None of this is about timing the market perfectly. It's about positioning. It's about owning assets that either hold value or profit when everything else falls apart. Treasuries for safety, inverse ETFs for downside capture, gold for inflation protection, volatility contracts for crisis profits, real estate for post-crash dominance, dividend stocks for income stability, and cash for opportunity. Most investors do the opposite. They chase momentum when markets rip higher. They panic sell when crashes hit. They buy high, sell low, and wonder why they're always broke while billionaires keep getting richer. The difference isn't intelligence, it's discipline. It's knowing what to buy before you need to buy it. So what does this actually look like in practice? How do you know when to make these moves? And more importantly, what are the billionaires buying right now in 2025 as warning signs flash across global markets? Let's start with the indicators. Billionaires don't wait for CNBC to declare a recession. They watch three things: credit spreads, insider selling, and liquidity crunches. When credit spreads widen, meaning the gap between corporate bonds and treasuries grows, it signals lenders are getting nervous. That happened in late 2007, again in early 2020, and it's ticking upward now. When CEOs and board members sell their own stock in coordinated waves, they're telling you something without saying it. They know the earnings report's coming next quarter. You don't. And when overnight lending rates spike or banks suddenly need emergency liquidity, the pipes are clogging. Smart money doesn't ignore that. They act. Right now, several of these signals are flashing. Corporate debt is at record highs. Insider selling hit a 10-year peak in mid-2024. Regional banks are quietly tightening lending standards. Consumer debt is ballooning while savings rates collapse. None of this means a crash is guaranteed tomorrow, but it means the probability is rising. And billionaires don't bet on certainty, they bet on probability. So what are they actually buying? Start with energy infrastructure, not oil stocks. Infrastructure, pipelines, storage facilities, renewable energy projects. Brookfield Asset Management has poured billions into this space. Why? Because energy doesn't disappear during recessions. Demand shifts, but it doesn't vanish. And infrastructure assets generate steady cash flow regardless of stock market chaos. They're boring, they're stable, and they're exactly what you want when everything else is on fire. Next, look at private credit. As banks pull back, billionaires step in. They're lending directly to mid-sized companies at 10% to 15% interest rates, fully collateralized. If the company thrives, they collect fat interest payments. If it fails, they seize the assets. Either way, they win. Apollo Global and Blackstone have raised record amounts for private credit funds in the past 2 years. They're not doing that because they think markets are headed higher. They're doing it because they see opportunity in the wreckage ahead. Then there's defense and cybersecurity. Geopolitical tension doesn't care about your portfolio. It escalates regardless. And when it does, governments spend. Lockheed Martin, Northrop Grumman, Palantir. These aren't speculative bets. They're companies with government contracts locked in for years, recession-proof revenue streams backed by national security budgets that never shrink. Bill Ackman recently disclosed a massive position in this sector. He's not buying because he loves war. He's buying because he understands incentives. But here's the move that separates the smart from the rich: distressed debt. When companies can't pay their bonds, those bonds trade at 20 or 30 cents on the dollar. Billionaires buy them in bulk. If the company restructures successfully, the bonds recover and they make 200% to 300% returns. If the company goes bankrupt, they end up owning the assets at a steep discount. Oaktree Capital built an empire doing exactly this. Howard Marks has said repeatedly, the best opportunities come when everyone else is running away. And right now, distressed debt is piling up in commercial real estate, retail, and over-leveraged tech startups. Now, what about timing? You can't predict the exact day a market crashes. Nobody can. But you can prepare incrementally. If you're sitting in a portfolio that's 100% stocks right now, you're not positioned. You're exposed. Start rotating 10% to 20% into safer assets. Not all at once. Gradually. Buy Treasury ETFs. Add a small allocation to gold or commodities. Open a position in an inverse fund, not to get rich, but to hedge downside. Think of it like insurance. You don't buy car insurance because you want to crash. You buy it in case you do. And here's what most people get wrong. They think wealth protection means making zero returns. It doesn't. It means making asymmetric returns. A 3% treasury yield might sound boring compared to a 15% stock rally. But if that stock rally turns into a 40% crash, the treasury holder didn't just preserve wealth, they crushed it on a relative basis. And when the crash bottoms, they've got cash to deploy while everyone else is broke and panicking. The richest people alive aren't trying to time every top and bottom. They're building portfolios that survive chaos and profit from it. They don't need the market to go up forever. They just need to be positioned correctly when it doesn't. That's the edge. It's not about being smarter. It's about being prepared when nobody else is. So here's the reality. A market crash isn't a matter of if, it's a matter of when. And when it comes, it won't announce itself politely. It'll arrive fast, brutal, and unforgiving. The people who get crushed will be the ones holding overvalued tech stocks, speculative crypto, and zero hedges. The people who thrive will be the ones holding treasuries, gold, inverse positions, real estate, and cash. Not because they predicted the future, because they respected the odds. You don't need to be a billionaire to do this. You just need to think like one. Stop chasing returns. Start protecting capital. Stop following the crowd. Start watching what the smart money is quietly buying while everyone else is distracted by hype. Because when the next crash hits, and it will, the only question that matters is this. Will you be the one panic selling at the bottom, or the one calmly buying while everything's on sale? The answer to that question gets decided right now, not when the crash happens. Now, the billionaires aren't waiting. They've already moved. They've rotated out of risk, stacked their hedges, and positioned for chaos. The question isn't what they're doing anymore. It's whether you'll do the same before it's too late. Because here's the truth nobody wants to hear. The market doesn't care about your plans. It doesn't care if you are going to start preparing next month. When the crash comes, it comes fast. And by then, the only move left is damage control. So you can keep chasing the rally, hoping this time is different, or you can build a portfolio that survives what's coming next.